Well, we got a new GDP reading out of the U.S. today, or a new look at a previous reading. Personal consumption was revised downward to 0.8% in the second quarter, and economic growth, that rose at an unrevised 2.1%. So what will the Fed take away from this update? Let's bring in Veronica Clark, economist at Citi. Veronica, thanks so much for making time for us.
Yeah, thank you for having me.
So how would you sort of characterize this, this second look at the GDP data here, coming in unrevised at 2.1% overall? What sort of signal does that send about the U.S. economy?
Yeah, I think there was an initial focus on this downward revision that we got to consumption in the second quarter. This is the third release that we're getting this data. We actually get more complete services spending data with this third release. And that did show that services consumption was maybe a bit softer than we were thinking. But I wouldn't actually read too much into it. We have seen an acceleration in, retail sales and consumption, as we're getting into Q3, the end of the summer. And we still have strong growth elsewhere. That downward revision to consumption was offset with stronger investment, which is still an overall pretty healthy picture of the economy.
Okay, so the consumer spending part, that really did jump out to me, because we saw something similar happening in Canada as well. It seemed like the consumer got off to a much stronger start this year, but then after some revisions, not so much. So we shouldn't really be reading into that as the consumer, there might be some cracks there?
Yeah, I mean, a lot of what's happened in the last, 2 years of data is we've had, very strong services consumption, both the U.S. and Canada. That's been, a big driver of growth. And that was, reflecting that we were rotating away from goods spending, and, investment was softer. In the last, quarter or so, we've really seen this broadening away from just relying on services consumption driven growth. We've seen it in goods and investment. Maybe, the Canadian consumer is feeling the bite of higher rates, maybe a bit more than a U.S. consumer would. But in the U.S., we're really still seeing a healthy picture for consumption, and that really comes down to the labor market has just been surprisingly resilient, and as long as everyone has a job, they do keep consuming.
Is that how you're viewing the sort of contrast there, the Canadian consumer being more interest rate sensitive, maybe perhaps because of the exposure to shorter term mortgages where you have to renew, and the U.S. consumer maybe a little bit more padded from that impact?
Yes, exactly. Yeah, I mean, our average mortgage in the U.S. is fixed rate for 30 years. So U.S. consumers will be much less sensitive to rates. I mean, households in both countries, have had improved balance sheets over the last couple of years. Pandemic support, really did help that. And of course, there's been, large wage increases, of course, high inflation, though, to offset some of that. But yeah, generally, I would see Canadian consumers as a bit more rate sensitive, for sure, than U.S. consumer.
I also saw that there was a stronger business investment highlighted as well. And I did think that was interesting, considering, higher interest rates, and you hear about businesses, not being able to even access borrowing as much as previously were able to. Mm-hmm. So the business investment part kind of jumped out to me. What can you read into it?
Yeah, it is pretty amazing. We have had, weaker investment, weaker manufacturing activity for a lot of the last couple of years. And, that makes a lot of sense. Yes, rates are high, and we had this rotation away from, spending on goods and back towards services. But that kind of seems to have come to an end. And, it goes along with this idea that maybe we are just a bit used to higher rates at this point. And, we've seen a demand, certainly increase in things like investment in aircraft. People are traveling again, investment in autos. There were still supply chain pent-up demand issues to work through there. But even that goods demand is broadening across a wide range of goods. And yeah, people are still spending, are still investing.
Yeah, I guess if the consumers are there, they're coming, they're buying, then you think, all right, well, I guess I can spend, and I want to be able to supply some of those shoppers, perhaps on, the good side or what have you. So you talked about the labor market. If people still have jobs, then they're still spending, and the strength that comes from that. What do you think we're going to see in the jobs data next week out of the U.S.?
Yeah. Hopefully we get that data. There's always the
Right.
chance that we get a government shutdown and that might get delayed. But yeah, I mean, I think it should look like a pretty healthy report. The other data that we got in the US this morning, same time as the GDP revisions, were very low initial jobless claims. They've been very low for a number of weeks now. And that is telling you that, yeah, layoffs are low. Labor market is still pretty healthy.
And when you're looking at all of this in the context of what it could mean for the Fed, as long as they can check out that data, like you mentioned, the jobs data for next week and the data beyond that, but the GDP data, the resilience, I think, of the economy, continued resilience. How does that play into what the Fed's next decision might be? Because it seems like some of the reaction today from investors has been more focused on that consumer data, the pullback on the consumer, and maybe that's taking some, pressure off the Fed. But how are you interpreting it?
Yeah, I mean, I think all the data we got today is surely still telling us that, this surprising resilience of the U.S. economy is still true. That story still holds. And that's very much what we heard from the Fed, just a week ago. We got, updated dot plot, updated economic growth forecasts in the SEP. And the message of that meeting really was higher for longer. They showed stronger growth expectations in the forecasts, lower unemployment rate expectations, still expecting, the Fed still seems to be expecting that we're going to get this soft landing and inflation, will slow and rates will stay high, as part of that. But I think the key takeaway there is that, we're focused on higher for longer rates, and we're still expecting that last rate hike this year from the Fed, penciling it in for November. But yeah, it's probably still down the line.
Okay.